Meta, Apple, and the other mega cap tech stocks are all feeling the heat. Joining us to discuss what's next in tech is Gene Munster, founder and managing partner at Loop. You got a good fixed income department, good Fed watching department there, Gene. Does anything specific to tech really matter in trying to make a decision on what to do right now?
Joe, as a tech investor, I've never been particularly focused on the Fed. In the decades I've been doing this, I've become a student of the Fed over the last 6 months. Don't fight the Fed, of course, is a tagline that would be the title of any book. In this case, I want to just outline what tech investors should be focused on.
Good.
There are two ways to reducing volatility and building stability in the market. There is the hard way for tech investors and the easy way. I'll start with the easy way. That is the Fed does its job, raises by 75 basis points. That will stabilize, I think, investors, tech investors, particularly given a sense that the Fed is being dynamic in its approach. The second, the hard way to build stability is to ensue panic. I think that we would see that if we get a 50 basis point move. I think the market would view that as a no confidence vote for the Fed. In that case, and your programming has articulated this well, as we, of course, would focus on the VIX. What is panic and when is a flush out? And historically, the flush out is when the VIX breaks through 40. We're at 33 this morning. So despite the fact that the Nasdaq's down 33% year to date, we just haven't hit that vortex yet. So I'm optimistic with some of CNBC's reporting that there is going to be a 75 basis point move. I think that will add some near-term stability. Still doesn't answer the bigger question, which is what's going to happen with tech over the next 3 to 6 months.
33 is a big number, Gene, and a lot are 50, 60, 70. So that's the average, 33. However, the combination of the stimulation from the Fed and from all of the COVID-related programs that we had, you add that with the notion that we're pulling forward all this demand because of the pandemic, and all those pandemic stocks ran to incredible levels. 33 might not be that much given the move that we saw in a lot of the mark based on all the easy money and just sort of that story that everyone fell in love with.
Agree with that. And I think that, when you have this breakup that we're having, especially with tech, I think that there is maybe some insight around how to navigate that breakup. A couple pieces to it. First is 2022 is the year where we stabilize the numbers. We've seen the growth over the past couple years, especially with these big tech companies. That's going to set up for easier comps in 23. So this is the year where we see some of those revisions. I suspect that when we hit the June quarter and they start talking about the September guidance, that's going to be the pain point that I'm focused on. And specifically, when you hit that pain point, I think that there is a shift. This breakup is emotional. The fear is what is driving that emotion. And as a tech investor, usually we discuss fair value internally. We have target prices of when we'd be buying companies based on fair value. Those are out the window right now. We're focused on bargains, and bargains have an emotional factor.
We got to run, but we're below what you think is fair value for a lot of these. So that
fair value, not at bargains yet. I think we're still 10 to 30% away from bargains.
That gives us an idea of maybe there's something beneath us other than just air. Anyway, Gene, I don't know. They told me we got to get. It's a 3-hour show, and we never have any time. Thank you.
Thank you, Joe.
Okay, we'll see you.